I'm not a mining professional, and I don't live in this world. But what I do work on, my background's in the investment management industry, is work at a think tank where we have specialists who look at oil, gas, and mining. And we're always thinking, and our audience is primarily financial institutions, investors. So we're always thinking, when is a reserve not a reserve from the investor's point of view, from a risk um, point of view? And so now, can I? Oh, can we? Yes, okay. So I'm going to cover. No, I'm going to. Let's just keep going. I haven't got much. I know I don't actually have much time. If we go back one, thank those who've not come across our work. We produce lots of reports on power and utilities, oil, gas, and mining, and looking at the viability of reserves against the science of carbon budgets. And that's probably what we're best known for, what coining the phrase the carbon bubble and stranded assets. And the analysts who work with me, our research is entirely focused. All of it is funded by philanthropy. All of it's downloadable off of our websites, and we produce tailored research that includes individual companies as well as whole sectors. And yeah, and I sit on the advisory board of GFANS. When we do these reports, we typically get about 300 investment managers and bankers coming along to the events, and probably about 80 companies from the mining and the oil and gas sector. And so it's got quite a lot of pickup. Thanks. Next slide. Okay, so carbon budgets. Look, there's so much in the IPCC, there's so much in the IEA about this, and everyone has different views on how big the remaining carbon budget is. But this is what it looks like from various sources that we've pulled together. And it's the emissions potential of listed reserves. Now, this is the reserves owned by publicly traded companies, so not including government, state-owned assets. These are the proved reserves there on the left, and then the listed reserves in the middle. This is the embedded CO2 in the reserves of publicly traded companies, and on the right is the remaining carbon budget. And we call it a carbon bubble, not to say that there's a financial bubble to this. There may be. It's because the first column doesn't fit into the last column, and that's it in a nutshell. Next slide. Another way of looking at this is we know what the emissions are of gigatons. It's about 40 to 50 gigatons of CO2 per annum. We can break that down into different warming potentials, and then we can have a run rate. So at the current run rate, I think we're pretty much at 1.5 degrees above pre-industrial levels of a global average mean temperature of around 16 degrees. We're kind of through that now, but people still think we've got a few years left. 2 degrees, which obviously we've not seen for millions of years. We'll probably go through that in the next sort of 20 years, and then 3 degrees sort of beyond that. But it's well within the range of potential from the reserves that we have. Next slide. Okay, now, and I'm just going to keep rushing through this because a lot of these are ones which I cut out. Thanks. Okay, let's look at that one. So what does this mean for investors? So the way we did this is we took reserves, the embedded CO2 and the reserves of coal, oil and gas, and we did it stock exchange by stock exchange. And that's quite crowded, this slide. So which is why North America is with the New York Stock Exchange. We put that somewhere in the middle of Texas by the looks of it. It's just a little bit crowded. There's two things to take away from this. Let's put aside Russia for now. The UK and the New York Stock Exchange are where most of the world's uh, coal, oil, and gas reserves are listed, and that's why the UK is so important. We talk about the UK being responsible for less than 1% of global emissions, but if you think of it in terms of the remaining carbon budget, what's listed in London, that actually gets you to above 15%, and that's why the UK is so important here. And the way that the Financial Conduct Authority overseas exchanges and listing rules through the London Stock Exchange is so important, and that's why we spend a lot of time talking about it. On to the next one. Yeah, and probably the next one. Thanks. Okay, so what is it the investors want to know? It's the risk of overinvestment is so real. I mean, we've heard about companies coming to market. I mean, it may surprise you. There's been 2,000 to 2,500 coal, oil, and gas initial public offerings on the world stock exchanges. That's raised $600 billion over the last 10 years. It's not like it suddenly slowed down. And when you add in high carbon sectors, including coal, oil, and gas, in the debt markets, the London Stock Exchange published just a couple of weeks ago, and do email me if you can't find the report. There's $3.3 trillion of new of refinanced debt through the bond markets that's going to be reissued in coming years shortly, of which about half of that is in your sort of super high carbon sector. And we saw just the other week, you probably know this, about Total raising a few $billion through the bonds market for their expansion. So investors want to know whether what they're financing, there's space for it in the atmosphere, and whether the different goals that we've set under the Paris Agreement will be met. So along the bottom, you've got future production from post-FID final investment decision projects. And then you've got your rapid transition pathway in the yellow, your fast transition, your moderate transition, and your slow transition. So there's a lot of already funded projects which there's no space for it in the atmosphere under these different warming outcomes. And that's really the heart of the conundrum, is the markets are still plowing more capital into projects where we know there's no space in the atmosphere. And that begs and gets to the question around the analysis of the geological assessments has to really incorporate carbon budgets centrally into the assessment of reserves themselves. Onto the next slide. So the IEA said that no new projects are needed at all in coal, and no new projects are needed. There's probably, and this is for conventional projects under a 1.5 scenario. There's some space probably for unconventional, like shale plays, but and here you've got again those different sort of scenarios and different warming potentials. So they're the three kind of core scenarios. You've got the IEA 1.5 net zero scenario, which is that black line. Then you've got the announced policy scenario, which gets you to about 1.7. And then you've got the current business as usual, the stated policy scenario, which is where a lot of the problem is. Next slide, please. Okay, so the way we model this is, like a lot of people, we use cost curves. So what you've got here, and this is again, it's an oil and gas project, so obviously not directly relevant to most of you on the call today. So you've got low cost projects on your bottom left, high cost projects top right, and then you can break down your onshore Middle East, which is your lowest cost. Then you've got your offshore, and so on and so forth. And so our current view is that to achieve the goals of the Paris Agreement, if you're using a purely an economic analysis, most of what's on the bottom left may get produced. It's the top right that's a problem. Okay, next one. So what we've done here is we've layered in against the this cost curve. We've layered in these warming scenarios. So you've got the announced policy scenario in the yellow, which is your sort of 0 to 10, and then which is sort of 1.7. You've got your 2, which is in the middle, and then you've got your 3, which is on the right hand side of it. Now, why is there no IEA 1.5? Well, the answer to that is because no new projects are viable under an IEA 1.5 degrees scenario. Next slide, please. So what we're able to do using data from groups like Rystad and others that we collaborate with, and all of this is you can download from Carbon Tracker's website, is we look at every single major producer of oil and gas, and then we look at what of their business as usual capital expenditure. So this is the capex they're spending now fits inside these different warming scenarios based on whether they're high cost and low cost. And so you can see that the most aligned are those with inside the moderate transition, which is in the yellow. But you can see you've got large numbers of developers of projects, like there's Suncor, which is your oil sands project right there on far on the right. Most of their projects are not consistent with the goals of the Paris Agreement. And then look right at the top there, just how much of the capex, which is in the blue, which takes you way beyond the goals of the Paris Agreement. Next slide, please. This just ranks it by companies. Again, it's all downloadable from Carbon Tracker's website. The next one, and then we do something similar. We score it here, different companies based on what are the hallmarks for compliance by looking at the investment, by looking at sanctioning of projects, production plans, and looking at emissions targets. So what you're picking up from here is we're looking at this very much from the supply, the production side. Do reserves fit? We're not looking at it from the emissions side, which is where very confusing things like scopes 1, 2, and 3 fit. Is that looks at emissions. We're primarily looking at, does the production fit? Next slide. So I said earlier that we should look at this stock exchange by stock exchange. This is adjusting for state ownership reveals the financial centers with the most emissions under investor influence, private, which is where the free float, i.e. is listed, oil, gas, and coal. Then the next one slide. And the size of it, we estimate just 2 years ago that this is $7 trillion of market capitalization. This is what all these companies are worth together. It's probably more than that now because this doesn't include the market bounce. It's probably closer to $10 trillion today, of which New York and London, the big ones up there at the top. Next one, please. And what I think shareholders, the kind of the investors that talk to us, are concerned about is that most of the listed companies own the high cost projects, and so there's a lot of potential exposure of the publicly traded companies to these potentially stranded assets. Next one, please. And in our estimates, and this doesn't quite add in all of the bank debt and the bond financing, is under business as usual plans, there could be $1 trillion of, which, you know, in anybody's book is quite a lot of cash invested in projects which are just not needed based on these different climate goals. And if we're serious about well below 2 degrees, I mean, if we're above, if we start getting to 2.7, we're past all these key critical tipping points that the scientists talk to us about. There's a lot of capex which is going to be stranded in, or deleted projects which will be unneeded or stranded in these rapid transition scenarios. Next slide. And you know, New York and London is where most of this risk is concentrated, and that's obviously why there's a lot of shareholder resolutions and investor discussions about what do we do with these projects and explorations which are not needed. Next one. I think I'm probably close towards the end. So New York is the exchange with the least aligned in terms of well below 2 degrees scenario. London is still up there along with these major other financial centers like Toronto, Sao Paulo. Next slide. Yeah, next one, please. Okay, so you can probably, if you want to get into what does this mean for individual companies, and we do a lot of individual company analysis, and you know, people in our team used to work at BP and Shell and are very used to looking at the geologists in the team looking at these projects. You can download this from the website or just go through the barcode. The next slide. So why is this all important? There's $65 trillion of assets overseen or part of this coalition, the Net Zero Asset Owners Alliance and GFANZ, the Glasgow Finance Alliance for Net Zero. And these asset owners want to ensure that their portfolios are credibly aligned with net zero by investing or companies that are Paris aligned or encouraging companies to be Paris aligned. And it's this assessment of the production plans and the capex which is crucial for determining whether these businesses are truly Paris aligned. And we need additional metrics to come up with a more holistic assessment. So where I'm looking at this is what's missing. And from my point of view, in the competent persons report and in the standards, whether it's PRIMS or PERC, we need to put more emphasis on carbon budgets, not as an afterthought, but as very much upfront into the actual legal and accounting definition of a reserve. If there's no space for the emissions in the atmosphere, then the reserves that take you above the remaining carbon budget are probably not reserves. And we need to get to legal and accounting definitions of reserves and assessments of reserves that factor that in, which probably mean things like AIM Rule 16 for mining, oil and gas companies needs to be rewritten, and the standards which, whether from the UN or from Crisco or others, need to be rethought to incorporate carbon budgets. I'll stop there. Thanks very much.
Fantastic. Thank you very, very much, Mark. And thank you, Aileen, for coming to the rescue with the slides. Round of applause, everybody, for Mark. Thank you very much. So, Mark, just then kind of almost attempting to interpret this through the eyes of someone who's by no means an expert in this space. So it's my understanding that in terms of a lot of the, let's go with the public side of things rather than the state side of things, a lot of that money is coming from, say, pension companies, etc., who need to try and find quite stable things to invest in. So it's in their best interests for the oil and gas companies to keep going, for the oil and gas companies to keep them, because of course there's now increasing pressure on the pension companies to divest away from this and actually see what you're saying here. Is that what's driving these dividends, etc., that are coming out from the oil and gas companies at the moment? And then my final question here is, if all of this is being effectively overvalued because that oil, gas, etc., will never come out the ground, why can't we just give it to mining? Because we do need to get the minerals out the ground to enable a just energy transition. What do you think?
On that last point, so you're absolutely right. But there's something else that's going on, which is a problem. So if you invest in a tracker fund, a lot of people do with their pension, and 70% of funds under management either explicitly or implicitly tracker. So you just mimic the market. 50 pence of every pound you invest will go into your top 20 companies in the UK market, of which many of them are oil, gas, and mining. So it's almost like a self-fulfilling prophecy that even though you want to get away from them because of the way the market is structured and the way that risk is defined, a risk is defined as divergence from the market, tracking error. So if you don't mimic the market, i.e. you move away from your old fossil fuel system and redeploy the capital into building this new energy system, that is defined by risk managers as too risky. And so you're kind of a catch-22 situation. You want to switch, but you can't, because switching away from the market is seen as a risky step. But that's absolutely what we need to do. So the thing about the projects, what I focused on is the capital expenditure on projects that we know are not needed, which we put the figure at $1 trillion. So the companies, and we've seen this recently from changes of view from Shell and others, is a lot of these projects from a decision to proceed to actually producing could be 10 years. Now, in 10 years' time, we think that the oil demand, for example, would have fallen. We've just seen announcements of the G7 for cancellation of coal-fired power in Europe. We think that the projects which they anticipate will be there won't actually be there, and that's really where the risk is in a misuse of capital. I think you've got it there, sir. It's a misallocation of capital, but it's slightly more problematic because a lot of the infrastructure of this system is being turned over all of the time. And I don't know if you've done a back of the envelope calculation of the total value of the world's fossil fuel, including coal, oil and gas, mining, pipelines. Have you got a sense of the value of that infrastructure? Any top?
We will do. So hold that thought, and we'll be able.
I'm going to give you a figure. It's somewhere between 30 and 50 trillion dollars is the value of the value of the fixed assets of the fossil fuel system, and we've got to be losing about half of that over the next decade through asset write-downs and retirement. And that actually is where a bigger part of the risk is the write down of the fixed assets of the fossil fuel system that we're going to have to remove to replace it with this new system that we're building with all these important critical minerals. And that really isn't something the central banks or the pension fund system have really thought about, is the loss of the value of the existing system as much as the new value from building the new one.
Thank you very much for that. So I guess this is something here where we need to work out how to use Matt's analogy, how do we take the red pill in a way that doesn't totally destroy what's going on in the blue pill world?
Right, and I've got a simple idea. I'd love to explore with people here a research project. And at the moment, the SEC, the Securities and Exchange Commission, there's there's two definitions or legal definitions of the reserve. The first is a geological one. Can you get it out of the ground? The second one is, can you get it out of the ground at current market prices? It's an economic test. And I would like to introduce a third test, which has as much written about it and as the first test, the geological test, and that's what we're calling an atmospheric viability test. As part of the geological assessment, the professionals part of this discussion today would have to write a review as to whether there's any space in the atmosphere for coal, oil, and gas reserves once they've been burnt. And we probably know from the answer to this is that the answer to that is probably largely no, there isn't. But you wouldn't know that from reading the current competent persons report or the prospectuses which are issued by coal companies and oil and gas companies. And so I think we absolutely need standard setters and professionals to address this head on in the competent persons report and include this third test, not as an afterthought, not as a moderating factor, not as a quote unquote ESG, because it's not an ESG question. It goes to the heart of the definition of what is a reserve. And we need to sit down and do some rewriting. And I've been trying to talk to the London Stock Exchange for a while now about rewriting AIM Rule 16 on mineral mining and oil. It hasn't been updated since 2009. And there's nothing in there about carbon budgets or the viability of reserves within different climate goals. And that's a project I'd love to see if we can work together on. And I know that lots of people will be interested in it. So we're not throwing everything out with the bathwater. So we still need to do these assessments. We just need to do a little bit more on the risk disclosure side.
Brilliant. Well, with that, thank you very, very much, Mark. Round of applause, everybody.
Thank you. Mark at carbontracker.org if anyone wants to write to me about this.